Look at two houses in the same neighborhood. They're blocks apart, but choosing one over the other could result in $1 million difference in your retirement wealth, and most people don't realize it until they've already spent years of their life paying for it. The dilemma usually starts the moment you receive a pre-approval letter. Seeing a high dollar amount with your name on it is exciting, and the instinct is to start shopping for homes right at the top of that limit. Lenders calculate that number based on your maximum debt-to-income ratio. They don't account for your investment goals or your emergency fund. Their approval number is a threshold that leaves you with limited financial wiggle room for anything else in your life. Consider a couple named Sarah and Jake. They go to a bank and get approved for a $700,000 mortgage. On paper, they can technically afford the payments. The standard reaction to that letter is to ask, "Can we afford this?" A strategic home buyer asks a different question. What happens if we deliberately choose to spend less? Relying on a bank's maximum approval shifts control of your cash flow to the lender. Setting your own budget below that line is the first step toward protecting your long-term wealth. This diagram maps out 4 paths Sarah and Jake could take. They can buy the $700,000 home, or they can step down to houses that are 10% less at $630,000, 20% less at $560,000, or 30% less at $490,000. Assuming a 20% down payment and a 6.5% interest rate, the $700,000 home costs $3,500 a month. As we move down the price tiers, the monthly baseline drops to $3,100, $2,800, and $2,400. Look at the exact cash gaps. Buying the house that is 10% cheaper keeps $350 in your pocket. A 20% reduction saves $700, and a 30% reduction frees up over $1,000 every single month. When you are negotiating a 6-figure purchase, a few $100s a month can feel small. The psychological challenge is recognizing that those monthly savings are worth more than the extra square footage. Because a mortgage is a 30-year commitment, you have to evaluate those small savings against the variable of time. Small monthly reductions, when sustained over 3 decades, grow into life-altering financial advantages. Upgrading your house triggers a cascade of secondary costs: taxes, insurance, maintenance, and utilities. These hidden costs push the actual difference 25 to 50% higher than the mortgage gap alone. Factoring in true monthly savings, you're choosing between 2 very different financial lives. Unlike a mortgage, property taxes and maintenance never get paid off. They stay with the physical house indefinitely. Then there is the interest. Over 30 years, borrowing the maximum means sending hundreds of thousands more to the bank for zero equity. The financial gap isn't just a temporary squeeze. It is a long-term drain on your monthly cash flow. Let's invest those true monthly savings at an 8% return over 30 years. Trimming the budget by 10% builds a $750,000 portfolio. A 20% trim results in a $1.5 million portfolio, while a 30% trim creates $2.25 million in investments. Picture 2 couples earning the same income. One chose a slightly smaller home at closing. 3 decades later, their net worth is millions of dollars apart because of that one choice. Sacrificing a slightly upgraded kitchen today buys a multi-million-dollar financial safety net for tomorrow. Those portfolios translate into tangible retirement income. Using a 5% withdrawal strategy, a $750,000 portfolio pays out $37,000 a year. The $2.25 million portfolio generates over $110,000 annually. That capital protects you against sequence of returns risk, the danger of the market dropping right as you retire. The buyer who maxed out their budget has high fixed costs and a smaller portfolio. If the market drops, they have no flexibility. They may be forced to sell assets at a loss just to keep the house. The buyer who chose the modest home carries lower fixed expenses. This reduces their withdrawal pressure, giving them flexibility to adapt if the market crashes. Choosing a lower mortgage creates a safety margin that protects your lifestyle from economic downturns. Wanting a premium home is an entirely valid choice, provided you understand the actual cost. This chart shows the trade-off. The status quo path prioritizes your physical environment today, which typically requires working a full career to retirement age with tighter daily margins. The pragmatic optimizer path moves the other way. Choosing a smaller home means a faster path to financial independence and more aggressive wealth building. Personal finance is about trade-offs, and your house size should reflect your long-term goals and risk tolerance. Let's look at the sweet spot strategy Sarah and Jake could use, the 10% trim. A 10% trim is often physically subtle. You don't have to leave the neighborhood you love, you just forgo a few luxury finishes or a slightly smaller floor plan. The outcome of this choice is that you arrive at retirement with a fully paid-off home plus nearly $40,000 a year in passive income. This windfall didn't require working harder or getting a promotion. It required exactly one measured decision at the time of purchase. Trimming your housing approval by just 10% is one of the most efficient ways to buy back your future time and freedom.